Everyone. Thank you for coming. My name is Monika Godek, and I'm Global Commercial and Business Development Director at Coinfirm, and I have a great pleasure of moderating this webinar. It's my first time at this role, so I believe that we will all survive. Today, with our panelists, Claudia Naiba and Mario Duron, we will talk about mastering crypto compliance. I encourage you all to be active and to ask questions or adding your comments on our chat. We will reply them during our Q&A session. Please also note that this meeting has an informative function and it's not legal or financial advice. Okay, here we go. Let me introduce our great panelists. Let's start with Claudia. Claudia Naiba is a highly accomplished regulatory and training lead at Coinfirm, where her extensive expertise in anti-money laundering, countering the financing of terrorism, and sanction compliance. With a strong background as a senior fraud analyst, Claudia has dedicated over 13 years of her career to navigating and mastering the complexities of both fiat and crypto-related industries. Claudia, please tell us something more about you and what fascinates you about your job.
Thank you, Monica. Hi, everyone. Well, first and foremost, I would say that crypto compliance and compliance in general, AML compliance, CFT, helps in reducing victims. Now, money laundering is not a victimless crime. We all know that there are predicate crimes that are at the beginning phase of money laundering process. So actually the reason why I started working in this field is because I want to be of help in this respect. Now, just a little bit more about my background. I have experience both in anti-fraud as well as AML compliance, both in the fiat and crypto industries. I have also worked in both the private and public sector. And prior to joining Coinfirm, I have worked with a financial, with an FIU basically. Having joined Coinfirm has provided me with the option to better this field of technological solutions that help entities as well as regulators to identify, mitigate, and stop money laundering, sanctions evasion, and terrorist financing. Thank you. Monica, you're muted.
Oh, sorry. Okay. So now it's the time for our second speaker, compliance expert Mario Duron from Sanction Scanner. Mario is also over 13 years compliance subject matter expert with a high level of experience in traditional banking and fintech compliance frameworks. He focuses to detect financial crimes, mitigate AML risk, and inherent gaps in compliance operations. His expertise includes crypto and fiat investigations, risk assessment, sanction screening, system testing, and reporting. Mario, could you tell us something more about you and maybe what are the main difficulties do you face on an everyday basis in your job?
Thank you, Monica, and hello, Claudia, and everybody. Well, my path into this crypto world has been like many others, has been traditional through traditional banking, traditional financial services, and sort of growing up through this process has been quite a challenge and quite a journey. I would say some of the challenges, and I'm sure that a lot of us have experienced this, has been really, going through the regulatory quagmire that's happening with crypto. How do you bolster your compliance program, to capture crypto specific risks, and in really trying to marry fiat and crypto? That's an incredible little dance that every compliance department has to do, and trying to figure that out. It's specific to the business is difficult. There's a lot of views. There's a lot of things that you want to do. So finding that balance is always a challenge. A challenge that I welcome, leaving traditional finance, coming over to fintech, to one of Africa's largest fintechs. That was an incredible leap of faith for me. So I've no reservations for having done it. It was an incredible experience. Met a lot of great people. Learned a lot also along the way, as many of us do, and really forced me to push the envelope to see how, you know, you can detect these risks, these money laundering, terrorist financing, this risks. And like Claudia said, you know, none of these crimes are victimless. There's always a victim, unfortunately. So yeah, so that journey has been incredible, and those have been some of the challenges.
That's right. Thank you, Mario.
Yeah.
Please also note that Sanction Scanner and Coinfirm have teamed up to bridge the gap between compliance in crypto and traditional finance world. Sanction Scanner, as a provider of AML and CFT solution, offers AML screening for customers and transactions, AML transaction monitoring, KYB, and 360-degree customer risk assessment solutions dedicated to institutions. Whereas Coinfirm, the world leader in blockchain analytics and RegTech solutions, protects entities from being tainted with funds originated from illicit activities like ransomware hacks, human trafficking, and terrorist financing. This partnership aims to revolutionize crypto and traditional finance sector, using AI and machine learning in compliance to create a trusted and secure environment for businesses operating in these both sectors. Okay, let's begin. Crypto compliance, simply defined, means by AML CFT cryptocurrency regulations. These regulations help in identify criminal activities and protect customers. Who exactly must abide by this? How and to which extent? These are the main topics that will be covered today. My first question is, what does the current AML regulatory framework for crypto businesses look like? Let's maybe start with Claudia.
Thank you, Monica. Well, that is a very loaded question with a very extensive reply, but I will try to keep it brief because we actually have a lot of topics to cover today. Now, just an overview of this. From an AML perspective, there are obliged entities and non-obliged entities. Now, obliged entities means that they are basically under a legal obligation to abide by AML law in the jurisdiction that they are either incorporated, registered, or licensed in. Now, obliged entities are categorized by the FATF in 3 different types: financial institutions, such as banks, payment service providers, and also, for example, a second type would be virtual asset service providers. We all know this, for example, crypto exchanges are one of these, is an example for this. And the third type is designated non-financial businesses and professions. Now here, what we mean by this is any type of institution that offers some access to the financial system. So themselves are not financial in nature, but offer a gateway to the financial system. Some examples for this typology would be gambling institutions, notaries, and so on. Now, the regulatory framework is provided by the FATF. Now, the FATF is the global and international trendsetter that comes into place when we refer to AML CFT regulations. Now, the FATF offers recommendations, best practices that each jurisdiction must incorporate into their national law. So each jurisdiction would have to have an AML law, and this AML law would have incorporated these recommendations from the FATF. Now, when it comes to VASPs, I just want to clarify one thing, that there are actually VASPs are actually one of the 2 categories of crypto market players. The second one being non-VASPs, meaning that these are entities that offer crypto-related services, but they do not qualify as a VASP under the FATF's definition. For example, we have mixers, DeFi services, P2P services here. And from a compliance perspective, when an entity that offers crypto-related services is formed, they need to identify first and foremost if they qualify under the FATF's definition of an obliged entity, and also if they qualify as a VASP. Now, this would be based on the FATF's definition, but first and foremost, they would have to look at the jurisdiction where they want to incorporate, register, or be licensed in. So this would be the basis of the regulatory landscape. Now, currently, when it comes to jurisdictions, from a compliance perspective, entities would have to look at where exactly they want to be registered, licensed, and incorporated in, because every single jurisdiction has their own AML laws, both for the traditional fiat system and also for crypto. And currently, there are jurisdictions that offer, that have AML legislation, full AML legislation for fiat services. But when it comes to the AML legislation for crypto, they are either non-existent, they are partial, or they actually have a very good detailed AML legislation. So when it comes to the regulatory landscape, we have this general overview that the FATF offers, and then we have this micro level at the level of each jurisdiction. I will stop here because there is so much more to say here, and I would like to hear Mario's opinion on this.
Exactly. Mario, it's your time.
Yeah, thanks, Manu. That's great, Claudia. You're absolutely correct. General guidance being given by FATF is incredibly important. Everybody should look at it, when trying to provide these services, obviously. One of the challenges that I have seen is, as you have mentioned, entering local jurisdictions. Every jurisdiction or every country that you're trying to provide your services in, whether they be fiat or crypto, they are not necessarily on the same playing field. Crypto may not be considered a legal tender. There may be some challenges already in the court systems in regards to that. Maybe your money remitter license or your MTL licenses do not allow for crypto, and how is crypto viewed locally by the regulatory agencies in respect to consumer protections. Some jurisdictions are more sensitive to that than others. So those are some of the things you need to look at in regards to local jurisdictions. Are you able to provide the right type of compliance framework for that jurisdiction? Do you have any local requirements for you to be locally not only registered, but to have local compliance department and local compliance officers for those services? All of that will affect, that mechanism of trying to go into that jurisdiction. I always say that it's good to always have either internal or external legal advice in regards to all of those. You don't want to go in and just start operating without having proper due diligence in regards to that. And that can take some time. It really can, but it's well worth it. You don't want to run afoul immediately going into a jurisdiction, especially, with your own customers. You want to make sure that you're developing your program the right way to provide the most robust, compliance protections that they can get and legal protections. So yeah, going into each country is very, very specific. I would always say when you leave your home jurisdiction, make sure that you go ready, that you're packed and ready to go, and that you have your game plan. Make sure you have your legal and regulatory game plan ready to go, and always reach out in advance. Always reach out in advance to try to see what it is that you're going to need as you develop that business plan. Yeah, but I completely agree with you, Claudia. It's very it's a dicey move. But yeah.
Yeah, I think you made a very good point. For example, we have seen in the past few years some entities that have left the jurisdictions because they previously did not have AML legislation for crypto, or they had it partially, and then they improved it. And based on this new AML legislation that they have now, these entities did not meet the requirements. So it was because it was extremely costly for them to update their systems, their compliance teams, if they had any, for example. It was extremely costly to bring up to date everything.
Correct.
Requirements.
I've seen actually exchanges in foreign jurisdictions where they began the process of just, just an overall, external visitation and or enterprise-wide type risk assessment. And when the results come out, they shut down operations. It wasn't even the legality. It was just looking at the risk level, and those running it were like, we don't have that capacity. Like you said, we have no way of being able to bring up the standard to that level. So they shut operations. Yeah.
Exactly. Now, basically, I would say that when you start a crypto business, or if you are an existent crypto business and you want to develop your well, to expand your reach in other jurisdictions, first you would have to identify what type of business you are. Meaning, do you qualify as a VASP? Does that jurisdiction have AML legislation? Then you would have to look at what is the risk-based approach that you have to take when you go into this new jurisdiction, or for the jurisdiction where you want to be incorporated, because then you would have to update or create a business risk assessment. So this business risk assessment means that you have to look at both the risks that you would be facing by going into a specific jurisdiction from their national risk assessment perspective, and also from the business type perspective. So for example, if you're a crypto exchange, you have to look at what would be the risks that you would be exposed to and create also a mitigating plan. Then you'd have to also create procedures and processes for customer risk assessment and customer acceptance procedures. So this would be the basis of you conducting business legally from an AML perspective.
Correct. Yeah, and once you have that down, that risk approach, through the governance, risk, and compliance methods, that enterprise-wide risk assessment, for those that have not been able to move past that or trying to figure out what to do, there are certain things that are being asked either by external, by regulators or by external auditors, and some of those may seem sort of common sense, but it's just sometimes it just slips through the cracks. You want to make sure not only that you have your risk appetite clearly delineated within the governance, risk, compliance framework for your entity or your business. Make sure that it's noted, your jurisdictions, your products, your clients, accepted business activities or individual activities, how customers will interact specifically with crypto, and how crypto is not only just a product in your suite of services, but really you're bringing it out to the forefront, that you're going to make it something that has its own focus. That's one of the best things that we've seen that really gives comfort to regulators and to auditors and to the business itself, that you are taking that culture of compliance to the forefront. Moving past that, really, how are you dealing with those inherent risks that you find? What controls, like you said, that you're putting in, the residual risk, looking for that residual risk, and how are you mitigating that? Those controls, and we're probably going to segue through this later on, but how are you planning, testing, deploying those controls? How are you involving other stakeholders at communication level? They're going to want to see your validation and your documentation of all of these processes, these controls you're putting in. I think a lot of us, as we got into the crypto compliance space, we was like, okay, what do I put in place? I have these risks. What do I do? I think these controls should not be too vanilla. They shouldn't be, I'm just going to put some transaction monitoring rules, and I'm just going to have investigators investigate it. No, it's not just that. We want to make sure that through your controls registry, that you're really trying to, pinpoint those risk points from your onboarding, all the way from onboarding through your transaction monitoring investigations, probably some advisory work, assisting you, second layer defense, assisting you into your first layer defense, and really trying to work those through. And it takes time. It's not done overnight. So having that culture compliance, again, having management understand from the beginning that this is going to take time, that this is something that that's worthwhile. And it may, in some instances, it may delay a product launch. It may delay a jurisdictional launch because you want to do it the right way from the beginning. You don't want to go and then all of a sudden have to retreat out. So yeah.
Yes, yeah, I fully agree with everything that you said, Mario. Basically, when it comes to crypto compliance and AML compliance, be it fiat or crypto, every entity would have to have a proper setup from that jurisdiction's perspective. Now, for example, don't, as you said, don't be vanilla when it comes to this processes, procedures, tools, softwares, everything, even the compliance team. For example, with the compliance team, there are jurisdictions that that require only for an MLRO to be the representative of the compliance department, and no other staff within this team. But there are others that require a higher number of people. And usually this is because also linked to the amount of users and the amount of transactions that you are processing on a daily basis, weekly basis, monthly basis, yearly basis. The higher the number, the higher the number of people you would have in the compliance department, so that you can properly identify, mitigate, and stop the risks that you have outlined in your AML processes and procedures. Now, when it comes to this vanilla type of processes and procedures, documentation that you have for these situations, you are completely right, Mario. This is a no-go, because you might think, I can just say that I do this and this and this, but actually you don't necessarily put them in practice, or put them in practice only partially, because now we have to be clear here that when it comes to businesses are created to gather revenue. But unfortunately, there is this compliance element there. And when it comes to this approach of actually being compliant on paper, but not being compliant in practice, is never a go-to. Because having worked myself in a financial intelligence unit in the supervision division, this is exactly what I did. My job was to identify entities that were not compliant, and FIUs, and this is a point that I cannot stress enough. Companies that have this lax approach on putting in practice AML procedures have always been caught, because financial intelligence units always have a multitude of options and processes to identify risks related to obliged entities. And whenever these obliged entities are found to be high risk from the financial intelligence unit's perspective, there are verifications conducted by the supervisory authority. So in this case, what happens in these investigations into the entities, you would have to provide them with absolutely everything that you have, from the written documentation to the tools that you are using and softwares to identify, mitigate, and stop those risks that you outlined in your AML processes and procedures, and also a list of all of your clients, and with everything that you have done from an AML compliance, as in KYC, ongoing monitoring, as well as how well have you mitigated the risks identified when it came to alerts identified during the ongoing monitoring process for each client.
Yeah, I just, it's interesting. As you're mentioning this, something keeps coming to mind. One of the challenges that I have faced at various institutions in traditional finance and in fintech was the proper, I would say, not detection, but the assignment of risk, because that's that's going to push, how, or it's going to guide, your policy, your procedure, your implementation, even your training. For instance, the ability to link relationships, something as basic as that, individuals that have multiple accounts, multiple types of accounts, or they have an entity and an individual account. So they're using multiple services that the institution provides, but they don't link those accounts together to the master relationship. Everything, it connects because they have, beneficiary owners that are the same. So I've seen institutions that don't link those up. So they may close one account for a specific risk, but the customer just flips and uses another one. So guiding that risk through the relationship cycle for that customer is incredibly important from the start, even from onboarding, now all the way through to the exit process. All that has to be connected. And how does crypto play in that? Specifically, if you allow the customer to use the individual accounts for on-ramping and off-ramping of crypto, what's he doing on the business side? Is he doing the same thing? Are you capturing it over there as well? So trying to, and, money laundering, terrorist financing, counter operations, if you want to call it that, it's not just in one type of account or just this one individual. It's through the relationship for the customer. And that I cannot stress that enough. Relationship management is incredibly important for risk because it permeates itself. It bleeds into other relationships. So that's very, very, very important. And the framework, if you want to call it the backbone of everything, and I think you and I have spoken about this before, is the access to good data. If you don't have access to data, if you're a compliance officer, chief compliance officer, MLRO, a manager, a team lead, and you need data, you have to fight for it in good data, not just data that kind of drops into some dashboard. No, like you need data that's coming from core systems to be able to see what is really happening, because that data may not be flowing correctly through. So your alerting systems that you're talking about, the TM, the investigations, it may not be, the fidelity may not be there. So how can you even report or even close a customer's account if your data flow is not being managed properly? Your screening, your API connections over to your blockchain solutions, if you're connected to somebody, all of that is data, and validate and test. Here in the US, model validation and risk management are number one and number two. That's what they're going for. So that is something that you really have to push on to make sure that it's integral part of our program. Like we said, no vanilla work here. You got to think outside of the box. You've got to get this data. So I think that is one of the biggest things that we want to make sure you have is that data access. So
yeah, indeed, access to good tools, service providers, and softwares that help you accurately identify risks, both direct and indirect, and offer you the possibility to correctly analyze these risks to see if they are indeed something that is within your risk appetite or outside of it, is crucial. And also, you might have this proper tools, softwares, and all other such providers that offer you very good data and solutions. But you also have to keep in mind that you have to have good employees, trained employees, both from an AML perspective and also when it comes to those tools, because they would need to know how to apply those tools, what exactly to look for, and do those tools that you are using and the data offered by those tools are actually valid. So when it comes to the tools, yes, they are crucial, but I think more crucial would be the compliance staff that you have. So training is a very important part of having a proper compliance program. Never overlook it, never underestimate its power, because if you don't have good people to with good knowledge and also who know how to use the tools, and when I mean by using the tools, I mean either having people that already know those tools or are familiar with those tools because they have used them previously, or you yourself as an entity proactively offer them trainings based on the trainings that those entities of your service providers are offering, or from an AML perspective, you can provide them with opportunities for certifications, for keeping abreast with changes in regulations, with different patterns especially in crypto transactions, because these patterns can change quite a lot when it comes to criminal activity, money laundering patterns. So there are actually a lot of tools out there and providers that offer very good trainings. Also, never forget to, if you have questions that are extremely specific, don't forget to ask them to your FIU. So to the FIU that your legal obligations lie with. I would say that this is something important as well, because from an AML program perspective, if there is something that you are unsure of, the FIU actually welcomes these questions. And from my previous experience, I've seen that entities are kind of afraid of approaching the FIU, asking them specific questions, because they think that the FIU would judge them for not already having the answer. But when you think of crypto, this is still a developing market. And when it comes to the regulations, they are still at their infancy. So don't think that if you don't understand something from the legislation of that specific jurisdiction your obligations lie with, if you don't understand them, or if it's something that you specific from them that you don't understand, don't think that if you're asking the FIU, you will be met with a backlash. No, the FIU welcomes these questions. Usually, FIUs also provide seminars to provide you with more information about the AML obligations that you have. So don't be afraid of reaching out to your FIU for any concern that you have. They would actually welcome these questions before they identify you of not having implemented them correctly.
Absolutely, reaching out. Yeah, that's that being proactive. It means a lot to them. You know, it shows that you're attempting to do this, and if they see that you're taking that approach, they're going to be more lenient on you. You know, they may help. You know, they're going to try to help you out. I've seen that multiple times when I was with a traditional institution, where calls to OFAC were normal, just to make sure. So things like that are very, very, very important. You know, you talked about training. I have this little question, which is, you know, do you have a crypto SME, or do you have somebody that's really just knows crypto? You know, and there's nothing wrong with either. But the one thing you don't want is to put somebody that knows about crypto, you know, into a position that requires SME knowledge. Not only is it wrong for the business, it's wrong for that employee. It puts them in undue stress that's not necessary. It puts them in there. There's like a personal issue, you know, as far as what are they liable for. There's a lot of things that can go wrong with that. And it's okay if you don't have anybody in-house that doesn't know crypto, maybe just a little bit. You can act as your own incubator and really work around that. And like you said, training programs, certifications, webinars, conferences, you know, having an active training program just for crypto, you know, thinking outside of the box. This is our crypto incubator program to make sure that our onboarding analysts that, you know, first line of defense know what they're asking for crypto, or if the customer tells them they're in crypto, this is the path they're going to take. What transaction monitoring analysts are going to do whenever they see activity with crypto, either through directly as on-ramp or off-ramp, or if they see specific notes or wires or anything like that. What's investigations going to do? Where is your crypto investigations really going to lie? Is it going to be with the investigations unit, or is it going to be its own unit? Are you going to spread the crypto knowledge around? Or are you going to have a specific sort of pseudo compliance department just for crypto to handle that? And being able to have that training across the board, depending on where they are, making sure that they're up to speed on, you know, regulations, bills, if you're in the US, depending on what US state, that's a whole different topic. 50 US states, they all have different approaches to this. But making sure that everybody's abreast and they feel comfortable. One of the things that I've noticed is that some entities, they make that statement, and we've all heard it: we don't accept crypto. Well, whether you do or you don't, it's fine, but you have crypto in your books, on-ramp or off-ramp at least. And I think it was 2 or 3 years ago, it was at least 10% of money transfers were already linked to crypto. Now it must be higher. So that type of approach, that mindset, we have to change. That's why we're having this type of seminar, and training is incredibly important. Partner with all the solutions, those blockchain solution entities, Coinfirm, Sanction Scanner, all these risks touch crypto. And we haven't even spoken about sanctions risk with crypto, which is its own major risk that you have to address, So it's training is, you can never overtrain, in my point of view.
You are completely correct. Also, I would say that also when it comes to training, just one more addition to this topic, and then perhaps we can move on a bit. I would say that it's very important for the compliance team to be aware of changes in regulation, and also to be properly trained in identifying, mitigating, and stopping those risks. However, the management of the entity also must have knowledge both of crypto as well as legislation. So what the compliance team, the chief compliance officer or the MLRO can do in this case, they can while they keep abreast with changes in regulations, they can also have either a monthly meeting every 2 weeks, or whenever there are changes in regulations, they can have meeting on this with the management, so they are aware of what exactly their company is facing. Because as a company, from an AML perspective, if you are not working properly, you may face retribution from the supervisory authorities. And we all know that this can come in the form of fines. It can come with the revoking of the license. And in severe cases, it can also lead to the management being sent to jail, for example. Of course, these are extreme cases, but it does happen. We have seen them happening. And also, I wanted to touch upon one very crucial piece of information that you shared with the audience, Mario. The fact that you, as an entity, may think that you don't have funds stemming from crypto. Now, as a fiat entity, you might have actually 2 types of exposures to crypto, either direct, because you are offering services both in fiat and crypto. For example, banks offer custodial services for crypto. However, there might be banks that actually don't offer any services relating to crypto. However, the funds that they actually do receive in their accounts stem from crypto. But what exactly can they do to identify this? Now, I have not seen this anywhere stipulated in AML legislation. Like, how exactly can these entities identify their risk exposure to this? Now, and this is something that we have touched upon, Mario, beforehand, and I would really like for you to give your input on this, because you have a lot of experience on this. But just to give the audience an idea of what I'm what I'm talking about here is that a bank, for example, may receive fiat, and this fiat can come from a service provider. Now, the service provider might be used by a crypto exchange for their clients to convert crypto into fiat, and then fiat is sent to the bank. Now, banks and financial institutions in general, from the traditional fiat system, have only a very limited view of their inputs and outputs. withdrawals and deposits. They can see only the entity that the funds came from or they are going to. But they don't have this visibility that you have on the blockchain. You can see on the blockchain with the proper tools the entire historical activity of the transactions. So Mario, can you tell us more about how actually can banks and other financial institutions from the traditional fiat system actually identify this indirect exposure to crypto?
Yeah, I thank you for bringing it up. I think this is one of those points that even regulators themselves may not have. They talk about it, but they don't know what guidance to provide, and it's unfortunate. But that is where we have to think outside of the box. And this is kind of merging two things that I've done before, specifically through the traditional banking side and the fintech side, which is, and I go back to it, is going after your data. Go after your data. One of the things that you have in traditional banking is you have the ability to, either through the MT 100, 200, 300, or 400, messaging system, is to be able to screen certain things. You have to screen your notes, you have to screen your counterparties, you have to screen your addresses, you have to screen all of that, obviously, for sanctions and PEP exposure. One of the things that you can do is you can attempt, if you have the resources, you can attempt to try to marry that with the actual wires. There's usually a wires scenario coming in and out as far as the counterparty name, and creating a specific database of those names, for example. Now, this is just an idea. It's something that could work. I've seen variations of it on the fintech side and on the traditional side. You have access to, I would like to see all domestic wires, let's say for US entity, I want to see all domestic wires for the last 90 days for these 50 names, these 50 counterparty names. And those 50 names are actually the crypto providers here in the US, the exchanges, the mixers, the tumblers, and those that are sanctioned or not sanctioned. You want to create a master list of these names, and then create a specific filtering system for that. So as a actual deposit comes through or wire comes in, you have an incoming wire, it'll filter through this list. So this requires you communications with engineering stakeholders and creating, maybe possibly outside of your legacy systems, a specific internal system that will provide for you a different type of alerting. Now, let's suppose you have 3 alerts that come all from Coinbase. As you see this data, you're able to see where your crypto exposure is. You're able to see, I ran it for 90 days and we ran, let's say, $10 billion through. I have 3% exposure. Right there, you have a data point, data. Who's actually interacting with that exchange? You have access to the data now from that Coinbase. Who are the main users? What are the highest type of wire transfers to Coinbase? How is that affecting the customer risk rating model that you have in place? Maybe you don't have a customer risk rating model. Then you see, we need to implement this because we have that risk, that crypto risk, diffusing itself through our data or through our customer base. So having access to that data, looking at how your customers are interacting with those specific counterparties, domestic and international, you can expand on it. And you can even go, even more focused and create a specific blacklist that you will not accept transfers from these exchanges, because you, through a risk assessment, you have to determine that these exchanges or, crypto service providers are outside of your risk appetite, because you have to accept that you do have a crypto exposure. So looking at data that way and thinking outside of the box and creating different tools, internal tools, and showing management the benefit of doing things like this. So when it comes time, you can say, I protected my customers, I protected their money, I protected the financial system and our entity, our bank, or our, fintech, our solution, so looking at things that way, scouring through the data and talking to other people and webinars like this and entities like yours, and really trying to think outside of the box that way. I think it's the way we have to go until it just becomes a more robust ecosystem.
Thank you so much, Mario. That was extremely detailed, and I think I hope the audience saw the value of this information. Of course, if the audience has questions on this or any other topic that we've touched upon so far, we do welcome that. We will have a Q&A session soon enough. Now, going back to Mario's last point, this is part of best practices, I would say, right? Based on the risk, identifying the risk exposure. Mario, what other best practices would you say are mandatory for crypto entities to apply?
We have seen especially here in the US, unfortunately, it's going through, regulation through enforcement is what we're seeing in the US, unfortunately, until we catch up with the rest. The ability for the fintech or the crypto entity to be able to really detect, one, where the customer is. I support VPNs, and this is a contentious issue with a lot. But knowing where the customer is conducting transactions from, not only at onboarding, that VPN question, but when they conduct crypto, it's incredibly important. You need to have a VPN policy that is clearly stated as to what services may or may not be used while a VPN is on. You need to have access to the IP location, the true IP location. There are some entities that will say, no, it's consumers' right to have VPNs on, and we're going to allow them to do that, which I completely understand. But then how are you going to explain to a regulator how to then, mitigate the risk? What if they've gone over into Iran and they're buying Dogecoin? How can you even prove it or not prove or disprove it? So that's when thinking outside of the box comes in, looking at ways to, create a compliance wrap around this to mitigate. So it would be, sometimes it will be maybe through your TM system or your case management system, where you're going to be like, okay, I need to create special rules for VPN, just for VPN. Am I going to have velocity rules? Am I going to have concentration rules? Am I going to have many to one, one to many rules around VPN? I personally prefer velocity rules, because when there's activity that is illicit or the bad guys are trying to get money through, they're not going to keep the money there for 3 weeks. They're going to move that money out as fast as possible to the destination where it's going to. So velocity is a key indicator. So when a customer's VPN comes on and off, what is the activity before and after that? What's the velocity? What's the percentage of flow through of those funds through the wallet or through the account with that VPN? It shows intent to either hide or to move through or to use you as a bridge. That is one way to try to mitigate that risk, and what type of assets you're going to allow with that as well. If you're actually in the crypto business, whether you're an order book, whether you provide the orders to a service or a VASP, how far are you going to let them go with that type of solution? So things like that, specifically also when it comes to sanctions, the sanctions exposure, if you're specifically in the crypto business, how much of funds are you going to allow through either through indirect hops? If you're going to allow up to 90%, 50%, that is also has to play part of your risk assessment and risk acceptance statement of how much exposure you want, indirect or direct, for sanctions, which obviously tools, blockchain tools will be able to show. So yeah, those are some of the risks you need to mitigate directly for crypto services.
Yeah, indeed, the location of the client when these activities are happening on the blockchain, when transactions are occurring, is quite important. And basically, I would say that this is where KYC procedures and tools used for this respect meets blockchain activity. Because you might have a tool that detects and oversees the blockchain activity of your clients, but you have to pair it with what other information you gather at the time of that transaction having occurred. Because as Mario mentioned, these tools identifying the IP location of your client at the time of that transaction can indicate that there is something more going on there that requires further investigation. So just having these tools and best practices in order to combine the two would be a very good start, because indeed companies such as ourselves, Coinfirm, for example, does provide you with very accurate and good data when it comes to direct and indirect exposure of your clients to different types of high risk, illicit and prohibited activities. However, you have to definitely, as Mario mentioned, marry them with other tools, because then you would have a you can have a full bird's eye view of the entity of your user's activity. Something Mario mentioned at the beginning, you would have to actually combine the activity of the client overall, not just for different accounts that they have or different blockchain addresses that they are using for different blockchain activity, but also combining the KYC tools and KYC information with their blockchain activity. They definitely go hand in hand. I have seen this as an investigator myself, and it definitely helps in identifying what exactly is happening behind the scenes.
Correct. Absolutely agree.
Now, when it comes to best practices, we have mentioned a few overall during this webinar, but I cannot stress enough the importance of transaction monitoring tools. Some entities would perform historical verification of the addresses of their clients at onboarding, but they do not perform any such afterwards, because they would say that, well, my client is clean. I have received from them only a very small amount of funds. But what happens if you don't have ongoing monitoring for that transaction? And that transaction actually was intended to finance terrorism, even if it's a very small amount. In compliance, we have the saying that $1 actually does not equal $1 in terrorism, because the amount of funds that terrorists need to supply their cells with the proper materials to conduct their terrorist activities is actually quite low. For example, in order to create a bomb, you might need an amount of up to $10 to create it. But think about it, how many lives that bombing attack can actually affect, and not just lives, but also the surrounding environment. So these are things that you have to consider when you perform verification of your clients. Don't keep it just at onboarding. And because the amounts that your client is transacting are small, it does not mean that there is no risk there. How would you know if you don't have the tools in order to perform ongoing monitoring? And again, going back to Mario's statement, you have to have good data. So, service providers that offer you good data.
Okay, thank you. Now it's time for Q&A session. I see one question. What are the potential consequences of non-compliance for crypto businesses? Here we could start with Mario, for example.
I would say, I mean, for non-compliance, I think one of the worst ones would be to allow that money laundering, terrorist financing risk to flow through into the system and injure others. That's one of the main ones. But for the entity, obviously reputational risk, legal risk, loss of licenses, bank charters, relationships with vendors, especially banking vendors. Those are some of the main risks, immediate risks besides fines. And like, Claudia, you had mentioned earlier, individuals going to jail. We've seen them on the news, and the effect on the company, that has downstream effects for the entity, the entire organization, when something like that happens, not being found non-compliant. And we've seen it so many times. So those are some of the main ones that come to mind. So we need to do it right from the start.
I agree. I agree. Plus, I would say that it doesn't matter if you have knowledge or you don't have knowledge of illicit activity being well, occurring through your services. Regulators can spot that, and even if you did not know that that specific situation occurred, you will still be liable for it. So this is why having proper tools and data and good compliance analysts with very good knowledge, both AML compliance and how to use the tools, is extremely important. So yeah, I don't think I have anything else to add on top of what Mario said. He basically touched upon the most important situations that would occur as a result of not being compliant.
Sure. And to summarize, I would like to ask you for the key takeaways from this webinar, and what resources do you recommend for further learning and keeping up to date with the latest compliance regulations?
Well,
Mario?
I would say first and foremost regarding FATF, you can subscribe to their newsletter. You can receive that way directly information about when they issue new guidances, new reports, and when it comes to the first topic, I would save it for later, and I will allow Mario to answer this question as well.
That's fine, thank you. I would say sort of along the same lines as yours, Claudia, would be, Department of Treasury, FBI, BIS, and FinCEN newsletters, and going into their websites and going through enforcement actions, review that, and also looking at what in the U.S. specifically each state is doing in regards to the businesses, where you're located for your businesses. Having that proactive approach and have it be part of your program. That's something I would advise.
Yeah, indeed.
Yeah.
Plus, there are quite a few international organizations that play a role as being the baseline of issuing recommendations by the FATF, and also reports and other best practices that they issue that the jurisdictions actually incorporate directly from those reports into their AML law. So I would say having knowledge of when these reports are coming out, and also keeping in touch with your financial intelligence unit are extremely important, because this would be the three main aspects that play a role in the development of regulations.
Okay, thank you so much. Claudia, Mario, thank you so much for your impressed knowledge and valuable opinions. I would like to thank you all for coming and for taking active part in this session. In case of any further questions or comments, we'll be glad to hearing from you. Thank you so much. Have a lovely rest of the day. Keep up with date with series of Coinfirm compliance and regulatory update webinars. Thank you so much. See you soon.
Thank you.
Bye.